Welcome, everyone, to Bitcoin Deep Dives by MyCryptoParadise.
Yeah, so glad you guys are here.
If you are listening to this right now, consider yourself officially part of the Paradise Team family. We are incredibly glad you found your way into the inner circle.
Absolutely. Welcome to the family, guys.
Our mission for today's deep dive, well, it's simple, but for your portfolio, it is absolutely critical. We are dissecting an exclusive strategy update from our very own Paradise Team expert, Simon.
Right, and Simon really holds nothing back in this one.
He doesn't. We're going to look under the hood to uncover the exact psychology, the tactical execution, and, the raw emotional discipline required to not just survive, but truly thrive in the crypto markets.
And survivals is not something we take lightly here. I mean, we really have to start with the brutal reality of the landscape we operate in.
We really do. Here is the staggering truth right out of the gate, and we need you to really hear this. 96% of crypto traders lose everything within their first 3 years.
Wow. Yeah. 96%.
Let that sink in. Just think about that number. And today, we are going to look at exactly why that happens, juxtaposed against a massive, a truly hidden danger currently lurking in the market.
Yeah, the wall.
Exactly. As we speak, there is a $200 million sell wall towering right above Bitcoin's current price.
It is a brilliantly disguised trap, honestly. And the difference between the 96% who lose everything and the 4% who succeed, well, it entirely comes down to how they interpret and react to that hidden wall.
Right. Which means today is not just about staring at charts.
Not at all.
It is about shifting you from a dangerous, emotionally driven gambling mindset into an elite, capital-protecting, professional mindset.
That is the core of it.
So let's look at the actual architecture of the trap that catches all those amateurs.
Yeah.
Bitcoin recently hit a high right around $71,700, and it is sitting directly at a major resistance level.
Yeah, and this is where the behavioral science gets so fascinating. Despite hitting this massive ceiling, retail traders are getting aggressively bullish.
They really are.
If you look at the fear and greed index, it is running incredibly hot right now. People are just euphoric.
But if you zoom out, the macroeconomic conditions haven't improved at all. I mean, we still have massive global tensions, like the ongoing conflict in Iran, heavily suppressing the traditional global economy.
Right, the macro picture is actually pretty bleak.
But hold on, let me play devil's advocate here for a second.
Sure.
You're telling me to ignore a raging crypto market because of geopolitical tension, but, we know crypto often decouples from traditional markets.
It can, yeah.
So if retail momentum is pouring in, couldn't sheer buying pressure just chew through that $200 million wall? Why assume the whales automatically win here?
Well, it's a fair question, but it fundamentally misunderstands the mechanics of liquidity.
How so?
So retail traders buy using market orders, right?
Yeah.
They buy at whatever the current price is, usually driven by emotion. But whales operate using limit orders.
Ah, right, the structural side of it.
Exactly. That $200 million sell wall isn't just a suggestion on a chart. It is a physical barrier of capital. The smart money is actively restricting upward movement by absorbing every single ounce of retail demand.
Wow, so they just eat all those market buys.
Yeah, they're essentially saying, go ahead, keep buying. We will gladly distribute our bags to you at a premium.
And the really terrifying part is what's happening beneath them. The buy-side order book, the safety net of limit orders waiting to catch the price if it falls, is dangerously thin right now.
It's virtually non-existent nearby.
Right. The only notable safety nets are way, way down at the $65,000 level, where we see these isolated clusters of 49 million and 50 million waiting.
Exactly. The liquidity void below the current price is basically a cliff.
Okay, let's unpack this, because the market structure we are looking at right now is perfectly comparable to a crowd of people running out onto a frozen lake to grab a $100 bill sitting on the ice.
That's a great way to picture it.
Yeah, they are so fixated on the money, they completely ignore the structural reality of where they actually are. Above them is this massive, incredibly thick ceiling of ice, like they've run into an enclosed ice cave.
So they literally can't jump or escape upward.
Exactly. But right beneath their feet, the ice they are standing on is dangerously thin. One wrong step, one single crack, and they plunge straight into the abyss.
Man, that is the perfect visualization of bad risk to reward. And the reason humans blindly sprint onto that thin ice, it all comes down to our ingrained biological bias toward the herd.
We just want to follow the crowd.
We do. When everyone on crypto Twitter is screaming that the bull market is back, your brain literally releases dopamine. You feel safe simply because the crowd feels safe.
Safety in numbers, right?
Yeah.
Even when the numbers are mathematically marching off a cliff.
Precisely. And because they feel safe, retail traders aggressively increase their risk. We are seeing this right now in the data with open interest spiking.
People are just loading up.
Yeah, they are taking on heavy leverage, borrowing money to amplify their bets, completely blind to the fact that the smart money has built a brick wall right above their heads.
So if the mechanics are so heavily stacked against them, why do so many otherwise rational people keep falling for it?
Well, it all comes down to the Lamborghini illusion.
Oh, yeah. The classic crypto trap.
Right. You log onto social media and you see a 19-year-old flaunting a luxury car, claiming they made millions overnight on some random meme coin.
Right, and it just messes with your head.
It does. The psychological pressure to replicate those fake highlight reel successes pushes people to take astronomical, literally company-ending risks.
They think it's a get-rich-quick scheme, but the reality is they just get broke fast.
Getting broke fast is the reality for that 96%.
Which brings us directly to Simon's golden rule. This is the absolute bedrock of what we teach at MyCryptoParadise. Simon's main focus is not making money.
Let that settle for a second.
Let me repeat that. His main focus is not making money. It is protecting the capital he already has. He has explicitly stated he would rather miss a trade entirely than risk his capital unnecessarily.
What's fascinating here is that letting go of FOMO, the fear of missing out, is undeniably the hardest yet most essential psychological hurdle for any trader to overcome.
It's just so hard to watch a coin pump without you.
Oh, it's brutal. Our brains are hardwired to feel the pain of a missed opportunity almost as acutely as an actual physical injury.
Wow, really?
Yeah. So overriding that primal scream, looking at the data, seeing the thin order book, and choosing to sit on your hands and do nothing, that requires an elite level of emotional regulation.
But wait, isn't the whole point of trading to make a profit? Like, if you're always playing defense, how do you actually grow your portfolio?
That right there is the ultimate paradox of professional trading. The truth is, profit is simply the mathematical byproduct of flawless capital protection.
A byproduct. Okay, explain that.
Think about it like a casino. If you protect your chips, you get to stay at the table. The longer you stay at the table, the more high probability setups you will eventually encounter.
So time in the market really is everything.
Exactly. The amateurs obsess over the profit of the very next trade, but the professional, they obsess over the survival of their entire portfolio over the next 1,000 trades.
That is such a massive mindset shift.
It is. And this has been the overarching mission of MyCryptoParadise since back in 2016, to transform this wild west of crypto into a professional space totally fixated on risk management.
So you aren't trying to get rich quick, you're trying to stay rich slow.
Stay rich slow, exactly.
So how does Simon actually put this defensive shield to work on the charts? Because eventually, you do have to enter the market. How does he decide when the math is actually in his favor?
It starts with the 80-20 rule of risk and reward. This is where the gambling mindset completely falls apart.
Right, because gamblers just want to be right all the time.
Exactly. Most amateurs want a high win rate. They desperately want the ego boost of being right 80 or 90% of the time. But Simon, he focuses strictly on the risk-to-reward ratio.
Meaning how much he stands to gain versus what he risks.
Right. If you have an incredible setup, say you are risking $1 to make $10, you can literally lose 9 trades in a row. You can be dead wrong 9 times.
And still come out okay.
Yeah. Because if you hit that 10th trade, you make all your capital back plus a profit.
That is wild. And an amateur does the exact opposite, right? They might win 7 trades in a row, taking these tiny little profits because they get scared and pull their money off the table way too early.
Yeah, they cut their winners short.
But then they refuse to use stop losses because their ego just won't let them admit when they're wrong. So that one single losing trade wipes out all 7 wins and blows up their entire account.
Exactly. And that flawed math is exactly why the macro 3-year cycle is the ultimate grim reaper of retail traders.
The 3-year cycle. Let's talk about that.
So Simon relies on this 3-year period as the ultimate test of any trading system. Because over 3 years, the market will throw every conceivable condition at you.
Right. You get the euphoric bull runs, the crushing bear markets.
And those agonizing months of low volatility, sideways chop.
The sideways chop is what really bleeds the gambler's dry.
Unquestionably. If a system relies on luck, the 3-year cycle will relentlessly hunt it down and destroy it. I mean, you might get lucky for 6 months in a bull market where a rising tide just lifts all boats.
And then you think you're a genius.
Right. You mistake your luck for genius. But when the cycle shifts into a complex corrective phase, the market just takes it all back.
So to survive that 3-year gauntlet, Simon uses a strict set of criteria for entering a trade. He demands what he calls confirmation.
He never just guesses.
Exactly. For example, right now at the 71,700 resistance, he is waiting for 3 very specific things before he even thinks about going long.
3 things. Okay, lay them out.
First, a definitive break above the resistance accompanied by a massive surge in buying volume. Second, a retest of that new level with declining volume, which proves the sellers are exhausted.
Yeah, that retest is vital.
And third, a double bottom formation on the on-chain data.
And that third point is really crucial. Looking at on-chain data means we aren't just looking at highly manipulated exchange volume, right? We are looking at the actual blockchain ledgers.
The real undeniable data.
Exactly. When we see a double bottom on-chain, it proves that massive wallets, the whales, have stopped sending Bitcoin to exchanges to sell, and they're actively withdrawing it to cold storage.
Which confirms actual spot accumulation at a price floor.
Right. Until all 3 of those confirmations happen, entering a long position is just a low probability gamble.
Here's where it gets really interesting, because the way Simon operates, it's not like a cowboy kicking open the saloon doors and firing blindly from the hip.
Definitely not.
A professional trader is like an elite sniper. But they aren't just lying in the dirt waiting, right? They are constantly actively calculating variables.
They're always doing the math.
Right. They are measuring wind speed, humidity, distance, and bullet drop. If the atmospheric conditions, the volume, the structure, the on-chain data don't align perfectly to give them a mathematical edge, they simply don't pull the trigger.
They just wait.
Exactly. They pack up their gear and preserve their ammunition for a better day.
That is a brilliant way to frame it because it really highlights how a professional dynamically scales their risk based on those variables. Simon doesn't treat every trade equally.
Right. Not every setup deserves the same capital.
When the probabilities are low, like right now, trapped under a $200 million ceiling with basically no floor beneath it, he either doesn't trade at all or he risks a microscopic fraction of his portfolio.
Just a tiny test size.
Right. But as the market starts checking off those confirmation boxes, the probabilities increase. And as the probabilities increase, he scales up his capital exposure to match the edge the market is offering him.
Let's apply this sniper-level calculation to the exact market data we have right now. What is the highest probability scenario Simon actually sees unfolding?
Well, to understand Simon's current targets, we have to look at the concept of market breathing. Simon views the market as a living organism.
So it's not just lines on a screen.
Exactly. It doesn't move in straight lines. It inhales and it exhales. He uses Elliott wave theory to map this out.
Right, the wave structures.
Yeah. Impulsive 5-wave motive structures are the massive inhales of the market. They are these powerful moves driven by heavy human emotion, either greed pushing up or fear pushing down.
And the exhales.
Corrective, 3-wave zigzags, or the exhales. They're just temporary pauses where the market catches its breath before the primary trend resumes.
And according to Simon's analysis of the current charts, the market is just finishing an exhale right now. It's completing a secondary corrective wave.
Which means it is preparing for a massive inhale.
But because of that heavy resistance above and the structural weakness below, the highest probability is that this next massive inhale is going to be straight down.
Yeah. Specifically, he is looking to position himself for the third wave to the downside. In Elliott wave theory, the third wave is almost always the longest, the most violent, and the most profitable wave to catch.
Simon actually compares catching this third wave to arriving at a party at the exact best moment.
Oh, I love that analogy.
Right. You don't want to show up early when people are just standing around awkwardly. You want to walk through the door right when the music hits, the energy peaks, and everyone is having the time of their lives.
That's exactly what catching a third wave feels like.
And the data supporting this imminent downside move isn't just based on wave theory. Simon tracks historical repeating patterns because human psychology basically never changes.
It really doesn't.
Right now, Bitcoin's price action is uncannily repeating a gold bullion pattern from all the way back in 1974.
Yeah, that part of his analysis blew my mind.
But why 1974 gold? Like, what connects an asset from 50 years ago to Bitcoin today?
It entirely comes down to macroeconomics. In the early 70s, the U.S. completely severed the dollar from the gold standard.
The Bretton Woods shock.
Right. Massive inflation followed, and gold experienced an explosive run-up as a safe haven asset. But that was followed by a violent blow-off top and a multi-year corrective shakedown.
So the psychology was all over the place.
Exactly. And Bitcoin, as the modern inflation hedge following the historic money printing of 2020, is tracing the exact same psychological trajectory of adoption, euphoria, and then that institutional shakedown.
Man. History doesn't repeat, but it certainly rhymes.
It always rhymes.
And speaking of repeating history, Simon also pointed out that Bitcoin is perfectly mirroring the setup that triggered the massive 2022 bear market.
Yeah, the technicals on that are scary similar.
He noted a very specific structural warning sign, a bearish green shooting star candlestick printing right at the 1.272 Fibonacci retracement level.
Yeah, the 1.272.
Let's break that down for people. Why does a seemingly random mathematical ratio like the 1.272 matter so much?
I know it sounds like math geek witchcraft, but it's actually a self-fulfilling prophecy in the markets.
How so?
When Bitcoin enters price discovery, meaning
it essentially represents a graveyard of trapped retail bulls who bought the absolute top.
Exactly. When you see that specifically at a major algorithmic resistance level, it is a glaring warning sign that a severe reversal is imminent.
And because of these compounding probabilities, Simon has clear downside targets.
Right, he's got the levels maxed out.
If this third wave inhale to the downside triggers, he is targeting $54,000 first. From there, it could cascade down to $49,000 and potentially all the way down to a major, highly liquid level at $44,000.
And $44,000 acts as a massive magnet for price because there is a vast pool of unchecked liquidity sitting there, and markets naturally seek out liquidity to fill institutional orders.
So what does this all mean for you? If you're listening to this and feeling a bit panicked because you hold a lot of Bitcoin, there's a crucial caveat here.
Yeah, please listen to this part.
Simon is not married to a bearish bias. He doesn't care about being right. He cares about protecting capital.
That's the professional difference.
If the market proves him wrong, if the smart money suddenly steps in, breaks through that 71,700 resistance with massive volume, and confirms it as support, Simon will instantly drop his bearish stance.
Just flip on a dime.
Exactly.
Yeah.
In his own words, he will immediately become best friends with the bulls.
If we connect this to the bigger picture, this kind of radical adaptability is the absolute hallmark of a professional.
It really is.
An amateur gambler ego trades. They fight the trend, insisting the market is wrong and they are right up until their account is completely liquidated.
Just stubbornly hold on.
But a professional trader flows like water. They have no ego attached to the direction of the asset. If the river flows south, they trade south. If the river suddenly reverses north, they turn their boat around instantly.
Flowing with the smart money. That is so powerful.
It changes everything.
As we wrap up this deep dive into Simon's strategy, I want to synthesize everything we've talked about today by reciting Simon's Trader Creed. This is the mindset you need to adopt if you want to survive the 3-year cycle.
Everyone should write this down.
Repeat this to yourself. I think in probabilities, not emotions. I remain calm and disciplined in every market condition. I respect risk management and protect my capital above all else.
And the next part is huge.
Losses are feedback that sharpen my strategy, and wins are the result of disciplined execution. I detach from the outcome.
That creed is essentially the antidote to the Lamborghini illusion. Detaching from the outcome, focusing entirely on the process, is the ultimate psychological freedom for a trader.
It truly is, and the entire goal of the Paradise team is to bring you into that calm, disciplined, professional mindset.
We want you surviving those 3 years.
Absolutely. Now, before we go, I want to leave you with a final thought to mull over, one that takes this philosophy even further. We've talked a lot today about the 80-20 rule of risk and reward in trading capital. But think about your own daily habits and the content you consume.
Mental capital, right?
Exactly. Your mental energy is just as finite as your bankroll. Are you currently risking 80% of your mental energy on low-probability emotional noise?
Like doom-scrolling crypto Twitter.
Yes. Doom scrolling, stressing over 1-minute charts, chasing the hype, all the stuff that ultimately leaves you mentally broke.
It exhausts you.
Or are you actively protecting your mental capital, choosing to invest it only in the few high-probability insights and discipline systems that will actually compound your wealth over the next 3 years?
The market will always be there. That $200 million wall will eventually be broken, or it will crush the unwary.
It's inevitable.
The only thing you truly control is your own capital, both financial and mental.
Exactly. Don't be the person sprinting out onto the thin ice just because the crowd is doing it. Stop, look up, assess the actual structural probabilities, and wait for the perfect shot.
Wait for your confirmation.
Thank you so much for joining us on this deep dive. We are thrilled to have you as part of the MyCryptoParadise Inner Circle, navigating these markets together. Stay disciplined, protect your capital, and we will catch you on the next one.